Everything we are doing, the goal is to build our NOI, because the net operating income is the one that will give you the value of the property or how valuable your property is. That is why the NOI is so important. So since you understand that why you're buying a property is to improve the NOI, then that should be one of your most important KPIs that you should monitor. How is your NOI growing? So the concept is, how am I able to control my income and my expenses for me to achieve the NOI that will allow me exit in next 5 years? So the thing about KPIs, they help you understand your budget and easily when you're going off track. So now the question is, do we have similar KPIs, or should all multifamily deals have the same KPI? And the answer is no. Although there are some core KPIs that every deal should possess. But aside that, your KPI should be dependent on your business plan. So there are 3 things I've been mentioning: budget, business plans, and KPI. So when you get a property, like for some of us that are new here, some of you that are new here, we don't just buy properties. It's not like buying a single family home. You just buy it because maybe you have extra money, or maybe they paid you some compensation at work. You just feel like investing it. That is not how it works with multifamily. With multifamily, we buy property after it has gone through some processes, like you've done the underwriting, the numbers pan out, it has gone through everything, and you now understand the business plan, because every property must tell a story. What is the plan? Why are you buying it? If there is no plan, no matter how beautiful it is, there's really no need for you to do that. So for you to understand why your budget is bleeding, first of all, you need to understand what the business plan is for that property before you can continue with it. You need to understand the business plan. So we have some types of KPIs that are aligned to some types of properties that you buy. We have properties that are value add. We have properties that are already stabilized and you just need to maintain it and ensure that there's cash flow. And you have properties that are distressed. There are different KPIs for those type of properties. So you need to understand what property are you going into, because it's from you understanding what the property is all about. That's how you create the budget, and that's how you create the KPIs. Now, the KPI will make you understand if your budget is off track, will make you understand if your business plan is off track. So I'm going to state out some common KPIs that uniformed around this type of assets or this type of business plan that I've mentioned. So once again, let me mention those business plans, the common business plan that we are aware of. Many of you would have heard value add. Value add is a property that either needs renovation and needs to be renovated and bump up rent. It can mean that a property that has property management issues and they are not properly managing it, and you need to come and maybe upgrade the property manager and improve the quality of the property and all that. Those things are called value add. So value add is not just about renovation. It can be anything that can add value to the property. The bottom line about multifamily is you're trying to add value to it to increase the value of that property for you to exit properly. So that's the end game of any deal that you are buying, to increase the value of the property and for you to exit. The second one is the stabilized cash play. I have one property that there was really nothing. It was just a simple kick and drive type of asset. The property was doing well, just for you to stabilize it and keep going. No renovation, no nothing to it. Just keep it stable and go. Some of you have seen my post. That was the game plan for that property that I sent out. I sent out a post yesterday. If you've not seen it, please go and check our platform. You see it. That property on its own, there was no renovation attached to it. It was a 2009 property. All we needed to do is stabilize it. It had high vacancies, that is 68% at the time when we were going under contract. When we took over, it became 38% because we needed to sweep out the bad tenants from there. It took us some time. After that, within 1 year, we were able to stabilize the property to 95%. So that was the plan of that property, to just stabilize the asset for you to start cash flowing. Then the third one that some of us have also heard is distressed properties. Distressed properties are properties that are having high delinquencies, turnover costs, and maybe serious capex execution, serious capex issues on those properties. You know those properties and you know the ones I'm talking about and all that. So these different types of classes of assets I just mentioned, they all have different KPIs that should align with them. But there are some common ones that cut across all of them that you should currently be looking at. And one of them is the occupancy. So regardless regardless of the assets, the business plan you're doing, one of the KPIs that is very important for you to look out for is the occupancy, because you need to know it's not just the physical occupancy. So there are two types of occupancy that you should be managing. There are the physical occupancy and the economical occupancy. For me, I'm more particular about the economic occupancy because that's how you know how healthy a property is. Not just that you be chasing how many people are on your property, you also be chasing how many people are paying. They're two different things, but they're all occupancy. So you can have people on your property 100% occupied, but just 70 people are paid. So that means your economic vacancy is 30%. That means 30% of your tenants are not paying. And that is a significant amount to just ignore. So it's not just for you to look at the physical part, look at the economic part. The other KPIs that you should also look out for that cut across all the things I've mentioned are collections and bad debt. So regardless, you need to know how much is coming in, how much are bad debt. I mean, that means how much are people not paying and not paying at all. They will decide not to pay and they will skip and that money is lost, or you take them to court and there's nothing you can do to collect those monies. So those are things you need to account for because that is going to tell you how strong your income is. And remember, the summary of this entire thing is we're trying to build your net operating income. The net operating income is what will tell you the value of the property that you're running. Let me backtrack. So in simple terms, what you're looking out for is your income and your expenses. The lower your income, the more difficult to be expensive for you to pay your expenses. As much as possible, you want to attack everything that is surrounding your income, everything that is going to affect your income. So now we have things that are silent killers of income, and that if you are not measuring them under collections, remember I said collection is the second thing that cuts across the border that you need to measure. So across that collections, there are some things that can affect that collections. I know if I mention them, you will know. Things that can affect collections are things like loss-to-lease. So let me explain what that is. Loss-to-lease is the market is at this level and currently your property is at this level in terms of rent. That means, let's say the market is collecting $1,200 for the same square foot as yours, $1,200,000 for a one bedroom, and you are collecting $1,000. That means you are bleeding $200,000. I mean, $200,000 you've not caught up with. That is the loss-to-lease. So you need to understand how much of those 200 that you are losing. So that's loss-to-lease. Another silent killer to your income, delinquencies. So when a tenant is not paying, that's a big issue. And look at it in this way. A tenant owes you $1,200 and has not paid for 3 months. You've lost 3 months money, and that will have a ripple effect on your net operating income if nothing is done. So that is why a good property manager at that point is required. So I'm not talking about property management at this time. I'm talking about KPIs. So but I need to break down what are the silent killers of your income. The other thing that can also kill your income, concessions. Concessions are good and bad. You just only need to know when to use them. So for us, we use concessions when we are just taking over a property and we're trying to attract only those that qualify, to just give them an incentive and so that we can fill up on time. And after we've gotten to a particular level, let's say 93%, we stop. All concessions, either we stop or reduce it significantly. Because yes, you want to give out monies to those tenants so that they can come and stay on your property, but in reverse, it's affecting you. Because if you're giving concession of 1 full month, I've been to a place where they've given 3 months concessions or even 1 month concession. 1 month concession of 1,000 divided by 12 months. That is the actual rent you are collecting. So let's say, for example, I like to do calculations, guys, so that you understand where I'm coming from. So let's say your rent is 1,200, right? And you are giving out 1 month free to your tenants because you want them to come in. Literally, you are losing $100 per month on your rent. That is 1,200 in a year for your rent. You might see that as insignificant, but guess what? Do this for 15 people. Let's assume we do this for 15 people. Each month you are losing 1,500 and each year you are losing 1,800. That can derail your property at that point. So that is one thing you need to look out for: concessions, bad debts, delinquencies, and a loss-to-lease. I've mentioned them. Those things are silent killers of your income. So when you are talking about collections, these are the things that you need to be measuring in KPI, and it cuts across all. The third thing that you need to measure is your expense ratio. So this is very, very important to me. And one of the things I like to target aside alongside my income is my expenses. I always want to be in control of my expenses because I can literally save a lot of money from just doing that. Some of you that have been here, I've spoken about how ICE came to our property in February and took 7 tenants, and within 2 weeks, 20 something units total left. So a property that was 95% or 98% occupied became something around 70 something percent occupied in just 2 weeks, just because of policies. That was it. So in that, we knew that it would take us some time to make those properties stable. So what we as a team decided to do was, since we really did not have a lot of control because we kept on doing our marketing and trying to attract the right people, for crying out loud, 20 something people, except you are picking every Tom, Dick and Harry, for you to fill a property back with 20 something people will take you months, because you need, out of maybe sometimes 5 people, only 1 person qualifies, or 2 people. So we knew that was going to take us time to build back to 90 something percent of where we were. So what we decided to do was to concentrate on the expenses more. So we litigated our taxes, we did our insurance within that period, we brought down our premium insurance, our GL and SS liability insurance, we reduced cost on repairs, we reduced cost on payroll, we reduced cost on so many things, and that was how we're able to go through those periods. Currently, right now, the property is back, we're almost at 95%, but that was how we're able to navigate it. So expense ratio or expenses is very, very important. You need to know how your money is going. That is a way for you to know if your KPI is on track. So a KPI will help you understand what that is. The next one is your net operating income. You need to monitor what that looks like. So I was talking to some investors in our last webinar for one of our deals, and I told them the truth is that all we are doing this for is our NOI. Everything we are doing, the goal is to build our NOI, because the net operating income is the one that will give you the value of the property or how valuable your property is. That is why the NOI is so important. So since you understand that why you're buying a property is to improve the NOI, then that should be one of your most important KPIs that you should monitor. How is your NOI growing? So for us, we know the goal of the NOI we want for a property that we are buying. So let's say we buy property A. Let's say we bought it for $10 million. But the idea is that we want to sell that property for 18 million in 5 years. You know that you need to do some things for that to happen. So that's the very beautiful thing about multifamily. You can control how the property performs. So the idea is concentrate on your NOI. What are the things that can build your NOI? Let's say property A that we bought, and at the time we purchased it was $600,000. And let's say the goal is for us to bring it to 1.2 million in 5 years, the net operating income. So for those of you that are new, net operating income is your income minus your expenses. That is what it is. That is, I got $1,000, my expenses is $500. My net operating income is the remaining $500. So let's not crack our head. Forget the name, just look at the concept. So the concept is, how am I able to control my income and my expenses for me to achieve the NOI that will allow me exit in next 5 years? So if my target is 1.2 million, so for us, that's what we do. We know our target, the goal is 1.2. We now address it backwardly to know exactly what each of those 5 years will require. So if I am currently at 600 and my target is 1.2, that means I have a gap of 600. So it means that I need an extra 600 within 5 years value for me to exit. So in that case, I divide my 600 by 5 years. That is 120. That means each year I need to build $120,000 on that property. So that is what a KPI will make you know, to know if you are hitting your target on your 120 each year. And if you're not hitting it, what should you be doing before 5 years? Because once it's the 5th year, it might be difficult for you to start adding value to the property. So that's for that. So those are the different core KPIs that you need to manage. At the beginning, remember I said something like, it's not all size fits all for KPI. Your KPI really depends on your business plan. So you get a property, you need to understand, first of all, the business plan for that property. Then you can now say, this is the KPI. So let's say I take a property and the property has heavy capex. So aside from these core KPIs I just listed, one of my KPIs would be to monitor the turnover time for my repairs. That is capex. That means I will definitely be doing some repairs on the property for me to improve on the value of the property. So if that's the case, the turnover time for those capex is very, very important. I will need to monitor how soon those turnovers will happen. So your business plan will kind of give you an idea of what you should be monitoring. So your KPI is the one that will streamline it for you to be exact. You know, business plans sometimes can be very ambiguous, can be very big. And the only way for you to break it down is through monitoring them with your key performance indicator. So based on it, like I said, it's not all size fits all. You need to understand what type of KPI suits exactly what you are monitoring or what you're looking for your property to do. And if you're able to address that, your budget will definitely be on track, because when you are checking KPIs on all these things, you're also checking the numbers, because multifamily is about numbers. You are directly putting side by side. This is my budget. This is my actual performance. That is, this property is performing at this level, but my budget is at this level. Why is my today's expenses higher than my budget? So if you have a KPI that is monitoring exactly what your income should be, so let's say I'm setting aside a KPI that should monitor how much my collections. It means that if my collection is supposed to be $205,000 every month, and in reality that collection is $190,000, it means that there's a gap of $15,000. My KPI should be able to spot that out and tell me that $15,000 is behind. What do I need to do? So that's for that. Then also, in terms of turnover time, for a property that needs to be stable, you'll be targeting your traffic. How many people are coming to your property? Not just that, how many is your property manager able to turn? That is, make them become tenants. So if that is your goal, to make a property stable, that will be your number one focus, apart from the core things I've mentioned. You want to know how many traffic is coming, where are they coming from, which of your units mix, because in multifamily we have 1 bedroom, 2 bedroom, 3 bedroom, 4 bedroom, depending. Which of those units mix are getting more attractions? Which of those ones are not moving so much in the market? What do I need to do? A KPI will help you understand which of those units are falling behind, and if you need to do some kind of renovation, or if you need to do some kind of tweaking for you to start performing. I've seen cases like every month I go back and I check our layout, which of our layouts are performing well, and it tells me something. It tells me what's the trend in the market, and I compare with what other properties are doing. So for a 1 bedroom, 2 bedroom, and a 3 bedroom, if I see that my 2 bedroom, 3 bedrooms are performing well, it just shows to me that I have more family-like people on my property. But if I see that my 1 bedroom is performing well, it just gives me an idea that we're having more single people in that neighborhood that need more accommodation. But if all of them are performing well, it also tells me that we have a mix of people in our local market and all that. So all these things, you need to monitor them. Like I said, it's not all size fits all. I will only do this if I'm looking to make my property stable. Like that property that I told you guys about that was 68% takeover at the beginning. Property like that, we're looking at our traffic, we're looking at our turnover. So if we have like 20 traffics coming into the property, when I mean traffic, people coming in to check whether to lease or not. So if I have 20 people coming and I'm only having one sign up an application, I'm asking a question to the property manager. What's going on? Why do we have one? Either they tell me that, oh, there were a lot of bad quality traffic, that is bad tenants, people that have felony on their record, their background check came out very bad, their credit score was extremely ridiculous, those things. Is either they tell me that, or they tell me that they didn't like the unit, or the pricing was too high. KPIs will help you understand exactly what the problem is. So you need to know exactly what your business plan is for you to set the right KPI. So in wrapping up, because I know some of us might have questions, if not, I'll continue. But in wrapping up, the beautiful thing about KPI is that you set it alongside with your business plan. First and foremost, you need to understand what your business plan is. You're not buying property because your neighbors are buying property, or because that's the trending thing in the market. Everybody's buying, so why not? Why shouldn't I buy property? So that's not what you're doing. You're buying property because it has a problem that you know you can solve and increase the value of it. That is the overall summary of why you should buy one. So once you understand the business plan, the next thing is this and this and these are the problems of this property. Okay, these KPIs will make me know if my budget is on track and help me understand where I am bleeding. Right? So there's a property that we took over. The property had low marketing, so we decided to improve on the marketing. But while we were doing the marketing, we noticed that the marketing had improved. We are having more traffic coming, but we were having issues with the type of quality or the demography of people coming in. So that gave us an idea of what to do, and we started fine-tuning it to see, okay, what are the ways we can improve to attract the right demography or the right quality of people that we need to come to our property and all that. So a good KPI should be able to help you understand that.